Now, what could the stock market plunge mean for you and your financial future? Joining us this morning with a little bit more insight is financial advisor and radio host Lance Roberts. Lance, anyone who checked their 401k after the markets closed yesterday probably panicked, not just a little. But how is this going to affect 401k plans long term?
Well, just for instance, we're probably going to see a bounce in the market today because of these unemployment numbers. Came in a little bit better than expected. But, one day's worth of numbers really doesn't change much. The reality is the market's been declining here short term because of, realization that the economy is actually much weaker than what we had expected at the beginning of this year. And so longer term, it's important to understand that when you're managing your own retirement money, again, this is money that you're saving for your retirement, and hopefully it'll be there when you get ready to retire, is that you have to understand there are risks in the market, and as we've been recommending to people over the last, really since April, have a little bit more cash, a little bit more fixed income in your portfolio right now to help lower some of this risk until some of this turmoil passes by. I mean, we've got Greece, we've got Italy, you have the debt ceiling debate going on, potential default, and when there's that type of turmoil going on, holding a little cash just helps smooth that out a little bit.
Some have predicted that all of this market turmoil could lead to continuing the economic slump that we're in. Now, for our viewers who are at home, who are concerned about their stocks, their 401ks, can they still grow their money in the markets as you see them right now?
Well, if you're talking about short term, we're probably in a case where we're going to have a lot of volatility here over the next couple of months. A lot of this will depend on whether or not we get another round of quantitative easing or these kind of Federal Reserve interventions in the markets as we've had over the last couple of years. So in the short term, right now, volatility is going to be very tough. We're going to have a lot of ups and downs. We may get a little bit of bounce today, but this is going to be an opportunity to raise some cash, raise some fixed income in your portfolio, lower equity exposures on this bounce, because the trends and the movements of the market are now negative, not positive. Now that will change, and when that changes, becoming more positive, then we can put more money back to work. But in the short term, be a little bit more cautious right now. Long term, we're going to be okay.
Okay, if you're cautious in the short term, what does that do to those folks who are preparing to retire this year or in the next few years?
Well, look, the bottom line is that we can't afford, if you're within 5 years to retirement, you can't afford another 2001 and 2 type decline or another 2008 decline, because you just simply don't have the time to make it up. So if you're close to retirement right now, your portfolio should be much heavier weighted in fixed income rather than being in equities, because if something goes wrong, you have no ability to repair your retirement. And so being cautious as you get closer to retirement. Look, I manage money for retirees. That's what I do. We look at creating income and capital preservation, because if we make a mistake, we destroy people's lives.
And we don't want you to do that.
Absolutely.
All right, thanks a lot. Lance Roberts,
you.
financial advisor and radio talk show host. Melissa.
No, full instead of empty, John. Jose, what do the experts have to say about it?
Well, we are taking an in-depth look this morning at the financial markets and what yesterday's losses mean to your wallet and mine. Joining us this morning, financial advisor Lance Roberts, also host of evening radio show StreetTalkLive.com. Thanks a lot for being here. Now,
morning.
You were live last night from 6 to 8 after everyone got that disappointing news about the stock market crash.
Right.
What was the mood you were feeling from folks talking to you, and what do you think the mood's going to be this morning?
Well, first of all, there's obviously a lot of concern now. On our radio show, though, we've been telling people since April to raise some cash, become more defensive because of the weakness in the overall economic structure that we're seeing. Of course, the whole debt debate issue that we were going through, Greece, Italy, Spain. The world is rife with all types of potential crises that could really impact 401k plans, your money at home. And so we've been warning people about that. So last night, the concern is now, okay, well, Lance, you've been saying this stuff now for 4 months. What happens here? Here's the crash. Unfortunately, it's too late to go sell now. Don't pay. And the one thing is, the old rule of investing is to buy low and to sell high. So this is a low, so it's not a good time to be selling here. But we do recommend, if you haven't taken any money out of the portfolio, raise some cash, become a little bit more defensive, lower your risk, that on a rally that we get here is to do that.
I heard an analogy, and it was comparing the financial market right now to a tide. And we're at a very, very low tide, but the tide will roll in eventually, and it won't be a tsunami, but it will bring everything closer to shore.
Well, the thing is that you've got to get an understanding of how financial markets work. See, people have been taught by Wall Street for the last 20 years that the markets just always go up. See, I put my money in, and it goes up. Well, the problem is that markets really don't work that way. They go up, just like tides. The tides come in, the tides go out. And you have to understand that when the tides go out and you lose principal, and you spend all the next wave that comes in just getting back to even, that's not a long-term investment strategy. So understanding that you have to manage some risk in your portfolio and pay attention to your money. It's your money. You've worked very hard for these retirement dollars. Pay attention to your money, because if you don't, nobody else is going to. And understand that there is risk in investing, and understand that you do have to manage that risk.
Okay, in the long term, we may have folks who may not want to go out to the beach to check out those tides. So how is this going to affect their 401ks in the long run?
Well, in the long run, again, depending on what your long run is. See, your long run is different than my long run, and my long run is different than somebody who's 20 years old. If your time frame is 5 years to retirement, you've got to be much more cautious. So more money into cash, more money into fixed income. If you really have 20 or 30 years to retire, then yes, more money into equities, because that will give you enough time for that to actually work to your benefit. But again, it's coming back to this. You have to pay attention to the clouds on the horizon, so to speak. If there's a storm on the horizon and you can see it, I mean, we're talking about crises in Europe and in the U.S., take some money off the table. And that way, when the storm passes, then you can put it back to work with a lot more safety.
Yesterday was one of those horrible days. The biggest percentage drop since February of 2009. Biggest point drop since December of 2008. Long term, how can folks think in terms of 20, 30, 40 years down the road now?
Well, see, that's the whole point. See, we've had two major crashes just in the last decade, 2001 and 2, 2007 and 8. You both lost between 40 and 50% of your money during those declines. If we have another recession in the next year to two, you're looking at roughly about a 30% decline on stocks on average. Stocks respond to the economy. Now, you tell me, is the economy strong right now or weak right now?
It's very weak.
Okay, then stocks are going to respond accordingly, so that means more cash, more fixed income for now. When the economy gets better, stocks will perform better. And again, the rally that we saw over the last couple of years was not because of economic strength. It was because of the Fed putting in $5 trillion directly into the financial markets. We don't have that right now. So this pullback or this crash in the market most likely will spur another round of quantitative easing. And then everything I just said goes completely out the window, because it'll be time to get back into stocks. So a lot of this is going to depend on the Fed here shortly.
But there is optimism, because that tide will roll in.
Absolutely. No, look, nothing goes down forever. Nothing goes up forever. It's just understanding that you have to manage your money. And again, it's not about glass half empty, glass half full. It's about the reality of the situation, because this is your money. And if you mess this up, you work through retirement, and Walmart's all full with greeters right now. So we got to make sure we do the right thing for your money.
Not half full, not half empty, but it does have something in it.
It did, absolutely.
All right. Thanks a lot, Lance Roberts.
My pleasure. Thank you.
John, thanks very much. John Donnelly live in downtown Houston, and we want to go and give you a little bit more insight now. Joining us live right now, financial advisor Lance Roberts, also radio host. Lance, you've been here all morning long. I know you've got a lot of work to do. This is your final segment. Awesome. I want to get your take on this latest tumble. More than 500 points, 513 points. We saw this morning the Dow jumped immediately like 168 points. It's back down now, 54 points. I mean, very volatile right now. It is.
And what's happening here, too, and Mr. Donnelly just kind of implemented this. There's a real disconnect between Main Street and Wall Street. The unemployment numbers out much better than expected this morning, but those were a lot of seasonal and statistical adjustments. Look at the participation rate. How many people actually have a job relative to the economy? That's at the lowest level since 1953. So if you look at the participation rate, household survey today actually negative. We actually lost jobs in the household survey. So the numbers we're getting out as people are starting to look into this are still showing a lot of signs of weakness in the economy that's weighing on the markets.
We've heard that phrase in recent weeks and really in the last couple of days, double dip recession. There are some people, I'm listening to traders on Wall Street saying, we never actually left the first recession. In your opinion, do you think we will get a double dip?
Well, I've been saying that now for about 6 months, and saying that you look at the trend of the numbers. See, and Wall Street and the media, they come out and they say, oh, it's in a recession when you're already negative. That didn't help you protect any money in your 401k plan. It's the trend. The trend is clearly negative. You look at the weakness of the overall environment, And again, the recovery we did have was statistical. $5.1 trillion we invested to get $600 billion worth of growth. That's $8 of stimulus for every dollar's worth of economic growth. The average American didn't see any of that. They're struggling to make ends meet right now.
And it is truly a global economy. I mean, there are so many other countries and nations that are struggling. I mean, you look at what's happening in Italy and Greece right now, and that's having a direct effect on what's happening here in the States, right?
Well, absolutely. We're very linked. I mean, everything we do, we're importing goods, we're exporting goods. Our financial system is integrated. News flow is immediate. Italy is on the brinks of following Greece into default. That obviously doesn't bode well for our economy here because of our links of of the way our economies work. So pay attention to these crises. We've been telling people now for a few months, raise a little bit of cash, be a little bit more cautionary. Don't sell now. The market's had a huge sell-off yesterday. Too late to sell here. Don't panic sell. But on rallies in the market, become a little bit more defensive until some of this stuff passes by. Then we'll have a much better opportunity to put money to work longer term.
I've heard more than one person come up to me and say, well, what are we supposed to do then? I mean, in terms of, you know, well, don't sell right now. It feels like a lot of people's hands are just kind of tied right now because there's so much insecurity going on right now.
It does. And when there's insecurity, there's nothing wrong with holding a little bit of extra cash until you feel better. Because, again, this is your retirement money. This is what you're depending on retiring on. And as we were saying earlier this morning with other segments, it's like the waves. They roll in, they roll out. Right now, the waves are rolling out. Be more cautious. And then when things calm down a bit, you'll know when. You'll feel better. Things will look better. People will be shopping and people will have better feelings about things. There won't be this bad news flow every day. Then you can put some money back to work. And honestly, you're not going to miss much.
Great insight, as always, from Lance Roberts. Appreciate the time. Get back to work.
Appreciate it.
We'll let you go now. All right, Natalie, over